Ladies and gentlemen, good day and welcome to the Prudent Corporate Advisor Q4 FY26 earnings conference call hosted by Avendus Spark Institutional Equities Private Limited. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Saket Gowda. Thank you, and over to you, sir.
Thank you, Julius. Good morning, everyone, and welcome to Q4 FY26 earnings call of Prudent Corporate Advisor Services Limited. First of all, I would like to thank the management of Prudent Corporate Advisors for giving us the opportunity to host the call. We will have opening comments from the management team, post which we will open the floor for Q&A. From the management side, today we have Mr. Sanjay Shah, who is Chairman and the Managing Director, Mr. Shirish Patel, Chief Executive Officer and Whole-Time Director, Mr. Chirag Shah, Non-Executive Director, Mr. Chirag Kothari, Chief Financial Officer, Mr. Parth Parekh, Head Investor Relationships. With this, I would hand over the call to Sanjay sir for his opening comments. And thank you, and over to you, sir.
Thank you, Saket. Thank you very much. And good morning, everyone. Warm welcome to all of you for joining us on Prudent's Q5 FY26 earnings call. Thank you for taking the time out with us today. I hope you have access to the investor presentation handy with you, because during the discussions we'll be referring to a lot of slides of the presentation. So before I move to the quarterly number, I would like to begin with what we believe is one of the most significant initiatives of Prudent. So please turn to slide 24 of the presentation which we have uploaded. So this year marks the 10 years since we launched Funds Bazaar in May 2016, a platform that has been central to our growth and to the lead which we have built in the B2B2C segment. Tech adoption has consistently been one of our key growth drivers, and we are now taking the next step in that journey with the launch of very powerful AI-led platform called Prudent Edge for our mutual fund distribution partners and Funds Edge for our retail customers on the Funds Bazaar. The platform is designed to transform the way distributors run their day-to-day business, be it goal-based planning or business analytics such as discontinued SIPs, EOM analysis, cross-sell gaps, ready-made email and WhatsApp communications, marketing support, research, and on-demand client reports. Activities that earlier required navigating multiple sections can now be completed with a single click or simply by voice, including in regional languages such as Gujarati, Marathi, Punjabi, etc. We believe this meaningfully bridges the gap between technology and the usability for our partners. The platform has just gone live in beta mode. We will closely track partners' feedback over the next few months and refine the engine accordingly. We see this as a timely and ahead of the curve step for the industry. With that, now let me move to the quarterly performance. Now please move to slide 16. This slide talks about the movement in our overall AUM. So if you look at this slide, it's talking about the movement in overall AUM, and on the left-hand side of the slide, we are comparing three numbers: the average daily AUM for the full year of FY26, the closing AUM as on 31st March 2026, and our current AUM as on 5th May 2026. So typically our AUM at the end of March tends to be higher than the fiscal year average. But this year the closing AUM of 1.19 trillion on 31st March came in lower than the full year average AUM of 1.21 trillion. This was largely due to market correction in the month of March. The good news is that we have bounced back strongly. Our AUM as of 5th March has already climbed to 1.33 trillion. This is 9.7% higher than the average AUM of full FY26. This gives us a strong, healthy revenue tailwind for the remaining 11 months of FY27. On the right-hand side, if you look at, it provides the trend of quarterly AUM, average AUM. Our average AUM for Q4 FY26 was 128,000 crore, which grew by modestly 0.3% sequentially. This is particularly noteworthy because Market fell by 14.5% during the same period. We managed to grow sequentially due to two reasons. First, we recorded our highest ever equity net sales in a single quarter of 4,300 crore. Second, the market correction was largely concentrated in the month of March. So on a year-on-year basis, our quarterly average AUM grew by a healthy 26%. Now please turn to slide 47. This slide shows how our equity AUM has moved both on a year-on-year basis and on a quarter-on-quarter basis. So let us start with the year-on-year view on the left-hand side of our slide. Our equity AUM grew by 15.4% during FY26. It moved from approximately 100 crore in March 2025 to 115,480 crore in March 2026. This represents an increase of nearly 15,400 crore. Importantly, this entire growth has came from net new money driven by our SIP flows and acquisition of Indus. Now coming to quarter-on-quarter view on the right-hand side, equity AUM declined by 8.2% during the quarter. This was primarily due to mark-to-market losses of 14,550 crore, reflecting sharp market correction during the period. However, the impact was partially cushioned by our highest ever quarterly net sales of 4,300 crore. Notably, our mark-to-market loss of 11.6% was significantly lower than 14% correction seen in Nifty 500 index, Sorry, I think the line was disconnected. So I'm again starting with our consolidated financial slide, which is slide number 51. Before that, I have explained about the SIP growth. So I think the last slide of our presentation, I think that's a very important one. So let me just again talk about the consolidated financials. So if you look at on a full year basis, our mutual fund revenue growth at 21% is in line with our quarterly average AUM growth of about 21.7%. Despite impact of back book repricing, our yield have remained more or less stable at 91 basis points, not only for the year, but for last 3 years in a row. So if you look at on a full year basis, our insurance revenue grew by 18%. This was on the back of a very strong growth in fresh premium, with health insurance growing by 35% and life insurance by 28%. The revenue growth was a bit softer than the fresh premium growth, led by rationalization of commission rates from 1st October 2025 in health insurance vertical on account of GST being reduced to nil rate and change in product mix on life insurance vertical. On account of strong growth in both these key verticals, total revenue from operation grew by 19.4%, and our commission and fee expenses, which is a very strong line item, has also grew in the same line and the same pace at 19.8% on a full year basis. Excluding ESOPs, employee expenses during the entire year went up by 21.2%. This is a bit higher on back of Indus acquisition and the cost related to all the employees of Indus, and one-time provision related to labor code changes which has came in last quarter. With our annual incremental capex cycle now complete and our entire team's review is also completed, we expect that the employee cost for the existing base will increase by approximately 14% in FY27. If I give you the indication, then our salary bill has moved from 8.93 crore in March 2026 to 10.2 crore in April 2026. Led by a healthy operational performance, operating profit grew by 18.2% and operating margin were stable at a 23.6%. Profit after tax was lower at 13.5% compared to operating profit growth, mainly led by a dent in other income due to market correction in the month of March. Of 585 crore of our treasury investments, 200 crore is parked by us in the Balance Advantage Fund and hybrid SIFs. On account of steep market correction during the quarter, other income turned negative by 4.7 crore as compared to positive income of 9.5 crore in the preceding quarter. This resulted in an overall drag on P&L for last quarter by approximately 13 to 14 crore. However, all the losses on mutual fund portfolio have since reversed. Current gain on the mutual fund portfolio stand at approximately 11.5 crore, and if market remain at current level, I think by 30th June we expect a very healthy income from other income side. On a quarter-on-quarter basis, our revenue grew by 5.1% sequentially, led by a 69% growth in insurance revenue. Operating profit grew by 19.5% sequentially, aided by lower employee costs. Employee costs were lower as variable pay provision required in the current quarter was lower compared to what was set aside in the preceding quarters. However, despite a very healthy operational performance, profit grew at a stronger pace of 2.6% at a slower pace of 2.6% due to negative other income as stated in the commentary above. Now shifting from our financial performance to the regulatory landscape, SEBI has recently made changes in the total expense ratio, and I would like to address a few points on that matter. First point is that revised expense ratio, which will now be inclusive of all statutory levies, including GST. It's a revenue neutral for those who are registered under GST, but the big advantage is that it removes the earlier anomaly where a GST registered distributor earned less than an unregistered one. This creates a level playing field and helps us attract smaller players to join the Prudent platform. So even though it's a revenue neutral as far as impact is concerned, strategically it is a very, very beneficial to us. We have aligned our payout structure in line with regulatory changes, wherein rate will also be exclusive at our end, and distributor who raise a GST invoice, we will be reimbursing him GST based on the invoice raised by them. The second point relates to the removal of 5 basis point benefit in lieu of exit load, which has been in place since 2012. This benefit, which was available over and above regular TR, has now been withdrawn by SEBI. While this represents a cost for the entire industry, we would like to highlight that broader implications are still being discussed and negotiated at the industry level. We expect greater clarity to emerge by end of this month, and we will update our stakeholders accordingly once the picture is clearer. So to conclude our full year performance, FY26 has been very, very satisfactory year for us. Despite two key headwinds, mark-to-market pressure in the mutual fund segment and yield rationalization in the insurance segment following the reduction of GST to zero, both our key business verticals delivered a close to 20% growth. This is a testament to underlying strength of our business model. A few highlights that stand out for the year: our equity net sales at 13,900 crore were the highest ever in the history. We added 5,100 new partners during the year, reflecting strong and healthy distribution expansion. And our health insurance vertical continued to deliver outstanding performance with fresh premium growing at a 35%. So across the board, our key parameters and the performance indicators have remained robust, and we are well poised as we move into our FY27. So with that, I'll open the floor for question answer. Thank you.
Thank you. We'll now begin the question and answer session. Anyone who wishes to ask question may press star and one on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Swarna Mukherjee from 360 ONE Capital. Please go ahead.
Hi, sir. Good morning, and thank you for the opportunity. Congrats on a great set of numbers. 3 questions from my side. So as you highlighted on the 5 basis point exit load pass on, you are still awaiting clarity. I just wanted to understand. I mean, I think last time in the earnings call, it seems like that the expectation from your side was that there will be a pass on. What is the factors why this is taking time on the lack of clarity is there? If you could highlight, has there been any deviation vis-a-vis what was your expectation previously in terms of the impact? So that is the first question. Second is, if I were to look at your standalone P&L, the fees and commission expenses, if we calculate as a percentage of the fees and commission income, there is a drop in this ratio. Just trying to understand, is this a function of Indus acquisition and more direct revenue? How should we think about it? And on the life insurance side, I mean, what is driving the growth in this segment? Because as far as we understand that apart from retail protection, I think the other segments which we do at the industry level has been a bit tepid in 4Q. So I wanted to understand that, our growth has been steady. So what is helping that? And also, given that our fresh to overall premium mix has, I think, improved, if I'm not wrong. So what is happening on the renewal side? Do we see any kind of persistency related impact playing out there? If you could highlight. Thanks.
So I think let me first of all address the second question related to your what you call the reduction in the or probably overall you are finding visibly reduction in the brokerage payout percentage. So I can tell you there are two important points as far as the revenue is concerned. So if you look at as you knew that Prudent, we have a annual additional trail which we pay to the partner based on their full year net sales, and the provision which we have made based on our assumption in first 3 quarters was sufficient enough for us, so that in the fourth quarter our provision was practically nil. So if you look at in the previous quarter, there was an additional trail provision of 5.5 crore. Finally, when the final number arrived, in the quarter 4, the provision for that was 0. So there is a 5.5 crore of extra, so lower expenditure because of that, number one. Number two, I think we have been all the time telling as far as insurance is concerned that we provide the revenue in our books only when we have absolute clarity. And there is a related to full year revenue of additional about 4.5 crore has been recognized by us in the month of March. So there is additional revenue of also about 4.5 crore. So overall, there is a 10 crore of extra revenue. I think that is the one major item. And probably the insurance revenue is also a bit higher because there are some contest related money would have came from the insurance. So all put together, I think that's the reason. But my belief is that when you look at the overall commission cost, you should look at the full year number, which is more representative from the point of view of your model rather than the last quarter. So that is number one. Number two, you are talking about regarding the clarity from the AMC side about 5 basis point is concerned. I think the large AMC has already communicated, and I think we assume that. So overall, we believe that as far as new business is concerned, our yield might remain neutral. On the book, we are expecting about 2-3 basis point impact. As far as exit load related pass on is the TR rationalization concerned, but still couple of AMC are yet to communicate clearly. That's why I think we are not able to tell you exactly that what is going to be the impact. As far as sharing this with our distributor partners are concerned, consistently we have been maintaining this stand that we'll try to share as best as possible, and if not more, at least in the existing ratio which we are having as far as sharing with them concerned, I think we'll be able to share that. So these are the two questions. I think raised two questions. I'll tell probably Shirish to address about the life insurance and there's another question also. Shirish.
Sir, just a follow up on this one, if I may. So I mean, in terms of the this you think that it will be relatively neutral in terms of the flow yield. So how does that play out? I mean, in the flow yield also, would not there have been an impact at an individual level?
So I think there are two things. One is AMC repricing on the existing book, and their call on the new business. So we believe, I think Shirish would be the right guy to also give you more clarity. But I think based on the whatever indication we have till now, I think my new book pricing might remain more or less similar because GST component has already been adjusted. So it was a very neutral for us. Mm-hmm. And 5 basis point impact is not on everybody. And somewhere I think our impact might be more or less neutral as far as new rates are concerned. On the old book, I think still will have some impact.
Okay, sir. Understood.
Which is going to be repriced. And that we need to pass on. So there are two things. Old book, whenever the impact will come to us, we need to share with our distributor partners. As far as new business is concerned, our rate would be more or less neutral. So I think we may not see a significant change as far as my payout is also concerned.
Right, sir. And this yield pattern would be similar vis-a-vis, say, a national distributor like us and individual agent. I mean, just wanted to understand that post that, would we be at a similar competitive advantage vis-a-vis AMC passing on to their individual agents, individual distributors?
So I think probably for us, the biggest advantage from 1st of April is the GST rationalization itself, because large players in the industry are less than 21 lakh rupees as far as 20 lakh rupees is concerned, as far as revenue is concerned. So most of the players in the industry are non-GST registered partner, and they had a huge advantage of GST. Now, with that advantage being gone away, we will be very, very competitive as far as what they used to get from AMC and what we used to offer. Now, their yield, their rate might remain the same, but because of GST being taken out, I think their yield from AMC will come down by 15%. So, automatically, we are competitive by almost 15% compared to the rate of AMC.
Right, sir. Got it. Understood. Yeah.
So, Sri,
yes,
LI and
on the
regarding the life insurance business, what you asked about that how we could grow better compared to the industry in the life insurance side. Two reasons I would say. One, definitely post 2023 in our life insurance business was little muted because the higher ticket side flow completely, majority of the higher ticket side flows died away. So last 2 years, I think business growth was not there. Of course, we took some time to settle down and also to change the product mix, what we used to sell. So if you look at in this financial year, the new category, I think we were talking last few quarters also, that tulip category, that term plus tulip category, I think we have been pushing this category very, very actively. So whatever we lost in terms of life insurance business from the guaranteed plans, what we try to recover through this particular product category. And this year, that category is the biggest selling category in our system. Because historically, we have been trying to sell term plans as well as mutual fund side or equity or SIP way. So the tulip plans of the industry, I think, serves both the purpose, which gives the higher life cover as well as the exposure to equity. And this product goes very well in our system, and hence I think we could navigate this particular business, and we are very, very confident that over time the tulip category will do better in our system, and probably that will help us grow our life insurance business. So that's the answer. And Sanjeev, any fourth question? I think I don't think that any question was there. Two questions already answered.
You were saying that, if you look at the persistency, he's finding that persistency is a bit lower. Could it be because of fresh and new composition or something else? That was the question, right?
Yeah. So by my calculation, the renewal growth rate has come off. While last year the last year's fresh growth was also better than the renewal growth. So I was just trying to understand that is there a persistency issue or any way to look at it in a different manner?
No, our persistency is still the highest. I think still we are maintaining more than 94-95% of persistency. So there is no challenges on a persistency side. Still we have maintained the same. So there is no challenges on that side.
Okay, so would this be then more like product mix of ticket size led?
Come again?
So I just wanted to check that, can this be like more a function of ticket size rather than, as you said, that persistency is not a challenge. That the renewal growth is a bit tepid vis-a-vis, say, a new business growth.
Chirag, can you take this question up? Chirag, are you there?
I think we need to also look at the data what you are referring. Maybe we can connect you offline and then take it, what data you are referring.
Sure, sir. Definitely. Yeah. Okay, sir. Thank you so much. Thank you and all the best for FY27.
Thank you. A reminder to all participants that you may press star and one to ask questions. The next question is from the line of Lalit Mohandia from Equirus Security. Please go ahead.
Yeah, hi sir. Good morning. So just two questions. So firstly, like as you mentioned that on the older book, there will be an impact of around 2-3 basis points from the larger AMC. So just wanted to understand, like on the non-GST distributors, like all the partners which we have, so are we aligning our distribution rates for them as well on the older book, or are we continuing with the earlier rates itself? And so secondly, can you give us the breakup of like the revenue of the other financial products income, which is like around 30-35 crores for the full year?
So I think as far as the rate alignment is concerned, definitely our payout will also get adjusted as per how the AMC has adjusted. So what we used to pay was the gross rate, and now the rate would be aligned by rate of GST on the book, if I'm talking about. So I think that adjustment will definitely happen. For the first time in our history, it is happening that our payout is going to be delayed by a few days this time, because still a lot of clarity is required from the AMC, and we have not calculated for the month of April. So it will be difficult to give you any clear indication as far as numbers are concerned. But yes, the rate would be readjusted so I think the same definition would be followed by us. We'll reduce the GST component and we'll probably pay the GST wherever GST invoice is raised.
Sure, sir.
Yeah.
And sir, should we believe that because of this rate alignment or the GST, so the smaller distributors in the country, like, they will be at a very disadvantaged state. So probably the growth or the additions or the newer channel partners at an industry level might slow down, like for the overall industry because of this? Or
so I think you look at it in both the sides. I think probably they need to work a little bit harder because they had an advantage of GST component, which was otherwise also not a part of your remuneration, and you are making a little bit extra because of GST. But you are right, for the non-GST partner, I think across the board, there is an impact of 15-20% of their revenue. And so we normally say that I think it's a 1 year mark to market and you need to work a little bit harder, but you are right. And probably for us, that is the biggest advantage also this year. You will see a lot of people getting consolidated under the platform because their competitive to sustain independently will become questionable, and they will also want that all other expenditure should be borne by somebody rather than facing the customer related. So you are right. I think we will see the more consolidation opportunity in the industry. Now, coming to your question about the bifurcation of our other financial product revenue of 33 crore, right? That is what you're asking about?
Yes, sir. Yes, sir.
So I think 22 crore has came from PMS, 6 crore from FD, so 20 plus 6, 28, and rest is probably small case and LAS and everything. So I think small product, but majority of the income is coming from mobilization through PMS AIF. So it's almost entire revenue other than FD, which is about 5-6 crore, is recurring in nature. And I can tell you, if you look at current year, our revenue in the other product has not grown because last year there was about 6.7 crore revenue from liquid loan, which has probably discontinued as far as product is concerned. So if you remove 6.7 crore from last year, my other product revenue growth is almost about 34%, which is visibly as of now only 5%. But if you struck off the liquid loan from last year, that growth is almost 35%.
Yes, sir. Yes. Great, sir. Thank you. Thank you.
Thank you. The next question is from the line of Deepanjan Ghosh from Citi Capital. Please go ahead.
Hi, good morning, everyone. So firstly, in your presentation, I see that there are around 1,000 MFTs who are 1,000 plus MFTs who can basically sell SIF. So just two questions on that front. One is, what would be the SIF flows in fourth quarter? And if you can give some color on the yield construct for SIFs versus, let's say, on the equity book that you have, how does it differ? The second question is on the life insurance business. Now, if I look at your annual yields, they seem almost similar, or maybe marginally lower compared to last year yields, despite 2H yields probably would have been lower because of the ITC impact. Now, you mentioned in your in your commentary that the term plus ULIP product has picked up. So is it just a function of mix change, or is there something to read more into the numbers? The third question is on the cash position. I mean, previously you have deliberated multiple inorganic opportunities. You have also kind of ventured and gone ahead with a few of them. So anything else that would be that one can expect going into FY27 or 28? Those are my three questions.
So let me answer about this third one first. First two Shailesh will try and address. So there, as far as acquisition is concerned, it's a work in process and continuously we have been exploring. So nothing at a concrete state, but I am sure something. I think it's in the process. We'll not say that something will happen in 27, 28, but or 26, 27, but definitely regularly कुछ न कुछ आता रहता है, and we've been trying and exploring that opportunity all the time. So Sirisha, about SIF and LI.
Yeah. So you asked about the flows in SIF in last quarter. So we did around 90 crores kind of business in SIF in last quarter. So currently, I think month on month, we believe that we have attained a run rate of around 25-30 crores now, and we strongly believe that this is still a new category for us, and incrementally every month, we strongly believe that this monthly flow will keep on increasing on SIF side. So today, I think in the industry has got around 6,000 unique distributors who are certified to sell SIF, and out of 6,000, almost 1,000 plus are done by Prudent and working with Prudent. So that way, we are very, very confident on. In the same line, the second question was, how is the margin in SIF versus other products? So probably the SIF margins are in line with mutual funds, so there is not much difference between SIF margin and the mutual fund margin. So you can consider SIF as part of the mutual fund sales or mutual fund margin only going forward. So the margin in SIF would be in line with mutual funds. So that is the second point. Third point, you asked about the yield experience in the life insurance side. So yield experience in the life insurance side, I think few of the things would be positive, few of the things could be negative in the sense which can bring down our, which has brought down yield. One is the ULIP category. Compared to the previous year, the ULIP sale has gone up by almost 5-6%, I would say. So you can see that the ULIP growth will bring down the yield in per se. So that is one. At the same time, I would say that the positive side post-October, definitely because of our quality of the assets and the revenue, the mix of the product, we could definitely maintain our commercials with most of the insurance companies. So obviously, I think that is a positive sign. So per se, I think we could maintain the life insurance yield. Of course, ULIP definitely will bring down some kind of yield, but otherwise, I think other categories we could maintain the yield from the life insurance side.
Got it. Maybe just one small question which I'll squeeze in. You mentioned that any repricing that happens in the mutual fund yields, the impact on back book might be in the range of 2 to 3 basis points per your best guesstimate at this point of time, and you expect the incremental flows to largely be neutral. Now, I just wanted to understand how the economics works for you. Let's say you generate around 100 crore of flows for a particular mutual fund, let's say in the month of May 26. Let's say that comes in at, let's say 90 basis points of gross realizations. Now, let's say the customer stays in the ecosystem and the AUM compounds over the next 3 to 4 years. How are the trail commissions organized in this case? If you can give some color on the economics of the business after the initial money has come into the ecosystem.
So actually, if you look at, because the transaction level yield is always defined. So for example, today I have brought somebody's 1 lakh rupees, wherein I am earning, let's say 90 basis points. So one is your back book, as on the book as on 31st March. Hypothetically, I am assuming that my entire book is going to be repriced by, let's say, lower than 2 basis points. So whatever the and so when it's a question of income, right? Say for example, Sanjay Shah has given me 1 crore before 5 years. And my earning on that particular investment was, let's say, 50 basis points. Now it will come down to 48 basis points. That is one part of the story as far as back book is concerned. Regarding the existing business, which I've told you that I don't see a significant change as far as my earning is concerned, because one was repricing back book, another was taking a call on the new business, and current indication is such that I might have an impact of 2-3 basis points in the back book, but not into the new business. If you look at my book and the new business, I think probably if you look at gross to net ratio of 50%, we are expecting that this year my gross sales has to be in the range of 35,000 crore on a total of 1,30,000 crore. So my net new sales is always in the range of 20%. So probably you might see that my book virtually would, a 20% book might get repriced by end of the year. But then as long as the money remain into the system, I think we'll continue to enjoy the same rate. unless there is a change in the back book repricing. Otherwise, we'll continue to have the same rate because the rate is mapped to a particular transaction, whether it is 1,000 rupees SIP or a 1 crore lump sum.
Okay, so
Could I be able to
just to
explain?
no, I think I get the concept. So just to kind of close the argument, you're saying that if you get, let's say, 1,000 crore rupees today at, let's say, 90 basis points gross yields, and the money stays in your ecosystem for next 10 years, the yields will be 90 basis points as long as there is no one-off back book repricing like some of the AMCs did last year, right?
Perfect. Absolutely.
Got it, sir. Thank you and all the best.
Thank you. A reminder to all participants that you may press star and one to ask question. The next question is from the line of Prayash Jain from Motilal Oswal. Please go ahead.
Yeah, hi. So I joined in a bit late. I don't know whether this point has been discussed. So one is the GST impact that is there, and the second is the exit load impact, the 5 basis points going away. Now, whenever you consider the passing it on to your distributors, what is the thought process that Prudent has with respect to maintaining its margins, whether it is the absolute spread that you would were earning. So, for example, if you were earning 90 bits and earlier you were giving 70 bits to the distributor, you were earning 20 bits. Now that goes to 88 bits. You would maintain that 20 bits and give 68 bits, or would it be on a percentage basis? How does the company think about passing it on to the distributors?
So I think you are right. Before you joined, we tried to discuss about how are we going to manage the changes which are going to happen. So one thing is we just wanted to communicate that whatever AMC has done for the distributors as far as changing the rate is concerned, because previously your rate was, let's say, for example, 1% inclusive of GST. They have reduced, the revised rate would be 85 basis points, and whoever is a part of GST has to raise an invoice for that. So the similar impact would be at our end also. However, we will not be able to crystallize anything in the monetary terms because here the April calculation is pending. So that is, I think that's the answer to your question. And second question you said about the exit load also, I think we are expecting roughly about, so then in terms of exit load also, if you look at the back book and the new business which will be mobilized, so we assume that as far as book is concerned, there might be impact of 2 to 3 basis points on the entire AUM on a weighted average basis. This is also presumption because still a couple of AMC are yet to be closed, but I'm assuming it will be in the range of 2 to 3 basis points, and that also will try and share with our distribution partners the way we used to share, either in absolute terms or in form of our percentage sharing. So I think that is about the exit load impact on the existing book. I think in the new business, current indications are such that probably our yield would remain more or less similar, and we do not see a significant change as far as my new yield is concerned, and hence probably the overall my pricing strategy also would remain the same.
Got that. And sir, the other part was the SIP run rate and SIP stickiness or SIP new generation. Now that the SIP returns have kind of been 1 year SIP returns have been very moderate for the last I think many months now, and it's reflected in your numbers as well. The SIP momentum has slowed down. What are the ground feelers that you're getting with respect to SIP momentum going ahead?
Sirish?
So in terms of new registration, last financial year, we have done the highest gross registration in terms of new SIP. That way, yes, I think you can say that I think post February mid and that time, I think, yes, we have seen some kind of low reduction in the new SIP registration. But annualized basis, we have done the highest ever SIP registration, new SIP registration. Regarding the termination or the cancellation, obviously, I think the last financial year, we have seen that higher termination compared to the previous year. Obviously, when the market returns are not that great, 2 years SIP are not delivering great returns, two things happen. The new registrations come down a little bit and cancellation increases little bit. So considering both these things, definitely the cancellation has gone up in last financial year compared to the previous year. But as I said, that the gross has helped to grow. Kind of returns continue for a longer time. Definitely there could be some impact on the new SIP and the cancellation both. Having said that, experience of investors, the confidence level of investors is much different compared to what it used to be earlier. So hence we have seen the trend that the cancellations are low and still the investors are giving more money. But again, that depends how the market returns in next 1 year. As of now, we are very confident.
Got that. Sir, my other question was on your overall revenue profile. How do you see that revenue profile between mutual fund, insurance, and other financial products? Obviously, that mix has gone through some changes over the last few years. How do you see this changing in, let's say, next 3 years? Do you think that these all the new businesses can scale up materially from here on, and what would be your dependence on mutual funds will go down? How do you see the mix panning out in the next 2-3 years?
So currently, other product revenue is very significant if I exclude the insurance side. So obviously, I think there is a lot of scope to grow the other product revenue. As Sanjay said earlier, that if I exclude the liquid loan, which product is not there now, last year other product revenue growth was around 34-35%, and PMS contributes the highest one. Obviously, as we know that I think PMS business is also kind of cyclical. When the market returns are not that great, PMS sales also comes down. So assuming in a normal scenarios, we surely believe that the PMS, AIF and the FD, which are the new products for us in the alternate side, definitely it is going to grow drastically up in our system as well. SIF is a new product category, though we consider or treat SIF as a part of mutual fund only. But incrementally, SIF is definitely going to contribute a lot in our system. Insurance, yes, we are very bullish on specifically health insurance side, so that component also may grow. But this financial year, we may see some kind of yield reduction in insurance because the regulator is talking about rationalizing the commission or not. But having said that, mutual fund business, we are very confident that we will grow it, though the base is very high, still it will grow. But all the products what we have introduced in the last 4-5 years may grow faster than the mutual fund in terms of percentage. But there is no clear-cut indication that what would be the percentage share of other products versus mutual fund, because we want to grow mutual funds as well.
Got that. And last question, sir, the MFD business has seen many players coming in. So do you think that the competitive intensity to acquire MFDs as well as the rates that one needs to share with these MFDs, that could be a challenge going ahead? How do you are seeing the competitive environment among different types of players, different types of national distributors? And because many players are getting into B2B2C mutual fund distribution now. So do you think that there is a competitive intensity will be high in terms of sharing, and that could impact, especially on the new flows front? Because back book takes almost a year to transfer, but at least on the new flow front, people can share significantly higher and take away some MFDs, or the incremental share could be lower for us. How do you see the environment there?
Perhaps now these new competitions are not new. Last year the same question definitely we could have said that they are new. Now they are already 2 years old. The competition is there for last 2 years. We have experienced what they are doing and what we are doing in last 2 years. Having said that, last that is 25-26, we have seen all this competition. But if I tell you that my equity gross sales was the highest ever, equity net sales was the highest ever, equity gross new SIP registration was highest ever, my health insurance business was highest ever, my life insurance business was second highest ever. So obviously the competition comes, we have to be mindful. But to be very honest, we have not seen any big impact or any impact in terms of business. We are very, I would say, alert what they are doing and what the competition can do it. But the other side of this coin, I would say that because of so many B2C platforms, I think more and more MFDs are becoming aware about the advantages of platform. So we also get this indirect advantage of platforms being more popularized. So obviously that is a bigger advantage. Then I think the worry about these guys will pay more brokerage and will take the distribution. And now I think specifically from April onwards, I think the level playing field with the AMCs, I think especially for the smaller distribution, I think the market for the platform business is going to become very, very big. So we are not worried about what this competition will take something, but rather I would say that the market has become bigger and bigger. I think how we can get the maximum pie out of the growth opportunity in the market. So that is how we consider.
Got that. Thank you.
Thank you. The next question is from the line of Gaurav Jain from ICICI Prudential Mutual Fund. Please go ahead.
Sir, thank you for taking my question. Just one question from my side. On Indus Capital acquisition, if you can highlight how much AUM we have been able to retain, if there is any attrition or outflow we have seen on that front is one. And second, do you think there can be further such acquisition potential opportunities which we can find in the market? That is all from my side, sir. Thank you.
So if I talk
already communicated.
You are taking this?
Sorry. Yeah. No, I'll just talk about the Indus, then probably you can just cover. So I was talking about the Indus as an acquisition. So I was saying that Indus, the experience has been very, very positive. We communicated that we acquired 2,085 crore was the AUM when we were supposed to acquire. And finally, I think 10-15 crore here and there, we got roughly about 2,060 crore in our core by end of September. And if I tell you the latest number, the AUM is 2,250 crore. It has grown in line with my overall AUM growth, and the gross sales, net sales, SIP book, everything has been reasonably great. I think the retention of manpower is absolute. Everybody is there. Not a single person is left. The senior guy who is managing the business is also very, very settled into the system. So overall, if you look at on all key parameters, I think the experience, adaptability, client adaptability, we have a couple of discussions with the client also. So overall, it's a very, very satisfactory thing. Regarding another acquisition, I think I already try and address that it's a working process. We regularly try and assess. So nothing is concrete. So I'll not say that something is definitely going to happen in next 3 months, but it's always a regular agenda for us to scout and look for some good acquisition. Yes, Rish.
I think you answered both.
Got it, sir. Thank you so much and all the best.
Thank you.
Thank you. The next question is from the line of Abhijit Sarke from Kotak Securities. Please go ahead.
Good morning, everyone. So my first question is on slide 32. Just wanted to check what is the AUM share of MFDs with more than 10 crores of AUM. I don't know if that number is disclosed anywhere else in the presentation.
I think there is a slide, if you look at more than 10 crore.
But the material is showing up on my
Now, you can go to slide number 32, where we say that we have 2,220 people as of 31st March who has crossed 10 crore AUM, and so I think we have not provided the AUM, but if you look at the average AUM, so I probably can give you the number.
Okay, and so just qualitatively, Sanjay sir, of the MFDs that you're acquiring, how has been the direction in terms of, firstly, at what AUM level they are joining the platform, and has it changed materially in the last 2 to 3 years?
Shirish?
Basically, MFDs joining are of 2 categories. One, new to industry, and secondly, the existing distributor. Almost I would say that 40 to 50% of the MFDs joining us, I think we convert them from other and bring them in the mutual fund industry. So practically they start at a zero AUM, zero mutual fund clientele and everything, and that is what we build upon. As I said, I think other 50% who joins us from the industry, I think they vary from zero AUM to even 100 crore AUM or 200 crore AUM. Many of the bigger MFDs don't join us for the mutual fund business. They join us for an alternate product or the insurance business, this kind of product. And when their experience becomes better, they join us or they may start doing mutual fund. So it would not be any single answer that at what AUM distributors join. So it's a different range.
Sir, alternatively, is there a leakage in terms of, let's say, somebody crossing, let's say, 100 crores or any such number? after which they want to venture on their own, or we're still not at that stage?
To be very honest, after 100 crore till date, I don't remember any MFD who has left. But yes, with the leakage specifically in the range of 10 or 20 crores earlier, and again that I would say, yes, we have not seen in that kind of drastically.
Got it, sir.
It's very difficult for any MFD to move out after attaining a certain scale. All their customers are on funds, moving their all the X platform to Y platforms becomes very, very bigger the scale. It's difficult for any MFD to move out of any platform.
Got it, sir. Thank you so much.
Thank you. The next question is from the line of Dipanjan Ghosh from Citi. Please go ahead.
Hi, sir. Sorry, just a few follow-ups from my side. One is if you can quantify the employee number as of March 31st. Second, given all the discussions around MF yields, would it be possible to give some color on what are the incremental yields currently?
As on 31st March is concerned, the precise number is 1540 people, and their new salary bill would be, I said, about 10.2 crore. So that is about the entire number of employees. Regarding the new business yield, it will be difficult because still, like as I told you that, and then the yield also vary based on the composition, which segment more money will come, which scheme more money will come. So it's not a single answer that, because you knew, right? Because if the more money comes in largest scheme of BEF, or the smallest scheme of BEV, I think the yield difference will be almost about 30-40 basis points. So to give you an indication that what is likely to be the blended, it will be very, very difficult. And that probably, and normally we are difficult to give you about the book yield and the existing business. Normally it's very difficult for us to, and normally we do not communicate also that number.
Got it. Thank you and all the best.
Thank you. The next question is from the line of Gaurav Cheni from Prabhudas Lilladher. Please go ahead.
Thank you, sir. So just two questions. So just to simplify, I mean, your MF distribution yields would kind of probably, go down a bit, right? Would that be offset by the fees and commission, right? So is that a correct way to understand? And hence, would we be able to maintain our net yields is the first question.
So overall, my yield should remain in the more or less. So my yield should not come under any compression because on the book, other than GST, we might see a 2-3 basis point impact, which to a large extent we should be able to share with our distribution partners. And the new business, I told you that I don't see any change as far as my yield is concerned. So overall, my book yield should remain static. I think whether my earning, how it will get adjusted would be, I'll be able to tell you only once the entire thing is implemented into the system. But somewhere we should see an improvement in our yield as far as my overall yield is concerned.
So you mean the net yield?
Yeah, net yield should be positive. Overall yield should remain more or less static. There are two things. My earning, let's say today I'm earning 91 basis points, for example, as on 31st March. My belief is that in April, on the total book, my yield might probably move by about 1.5 basis point on the total, 2 basis point. But overall, my five, because I'll be able to share this with my partner also. So overall, my earnings should not go down in any case. I think I should be able to protect my overall earning yield.
Which is what I was trying to get at, sir. I got your point. So appreciate that. And then lastly, what is the expected ESOP cost in the upcoming year? This year it was, I think, 3.3 crores.
So last year it was about 6.7 crores, or let's say it was 7 crore on an annualized basis. I think I assume that it has to be linked to the stock price, because at 2,600 rupees, I think the cost was roughly about 7 crore. So probably, I don't know what is the price of the share, but one thing is clear, we have decided that every September or October we are going to announce the ESOP now, because so that we can have next 4 quarters continuous amortization, and there should not be any spillover into the, so there should not be a double provisioning on a particular quarter. So now, more or less, probably number of shares might change by few shares here and there, but so probably you can assume that cost might go up by 15-20%.
So you mean the total? Yeah, total ESOP cost.
So if let's say this time the cost is likely to be 7 crore, next year it could be 8.5 crore. It's yet I have not gone to the board. I'm just ballpark number. You cannot take it as a projection, but I'm just giving you my thought.
Understood. And sir, correct me if I'm wrong. You mentioned that total employee cost would grow by 14% in FY27, right?
Yes. Not the total cost. My existing employee salary, which used to be 8.93 crore in March, would be 10.1 crore in the April. Same people who were on the books. So I'm not talking about the April. Maybe बहुत सारे लोगों ने join किया हुआ है. So I'm not talking about their salary. The guy who was with me on 31st March, his salary has been revised on 1st of April, and that growth is about 14%.
Understood. Perfect. Thanks a lot. I appreciate your inputs.
Thank you. The next question is from the line of Lalit Mohandio from Equirus Securities. Please go ahead.
Yeah, hi, sir. Just two follow-up questions, sir. So, like in the last quarter, we had mentioned that like the AUM coming from the top 5 AMCs were in the range of around 50-51%. Now, I just wanted to understand, like from a flow perspective, where would that number be? And also, within that total AUM of around 1.33 lakh crores, like could you just bifurcate it between the direct channel AUM and like the AUM coming from the partners level?
Yes.
Basically, all 5 AMCs, as you said, contribute around 50% of the AUM. And between direct and the regular channel, I think the ratio what we maintained earlier also, that still continues as it is. Around after in this acquisition, it has changed little. Right now it is 90-10. So 90% contribution comes, the AUM wise, 90% of the contribution is from our B2B2C channel, and around 10% contribution is from the direct plus Indus channel.
Yes, sir.
If I talk about the new flows, if you talk about the new flows, it would be around, you can say 6 to 7% coming from the direct channel, and almost 93-94% coming from the B2B2C channel.
Right, sir. And so like from the top 5 AMCs contribution from a flow perspective, sir,
It's similar. There is hardly any change. There could be a change of 1 or 2% because new AMCs coming in, they might eat into some kind of share from the bigger AMCs. But if you look at the share of in the business and share in the AUM, of course, there would be the new business share would be little lesser than the AUM share. But there is no drastically different because, as I said, new AMCs will eat into the existing assets of the bigger AMCs. But there is no meaningful difference you can highlight.
Sure, sir. Yeah. Thank you, sir.
Thank you. The next question is from the line of Sanket Gowda from Avendus Spark Institutional Equities. Please go ahead, sir.
Yeah, thank you for the opportunity. Sir, if I look at the gross flows numbers in the current quarter, it seems to be more driven by the lump sum number rather than the SIP, which has been pretty stable. So just wanted to understand whether this amount came predominantly when the market corrected, and is it fair to say that it might not repeat if the market comes back, and therefore we can go back to that lump sum number around 4,000 odd crore kind of figure instead of 5,300 crore figure what you experienced in the current quarter? And I just wanted to understand whether it came in the month of March or it was more uniformly distributed.
So basically, I think whenever market corrects the initial phase, historically we have seen that the lump sum money takes the advantage of the market, and hence the lump sum flows would be higher than the SIP flows during that period. Long term, I think always you would see that currently in our system, almost it is 50% kind of number. So long term, I think 50% contribution comes from kind of SIPs and almost similar from the number. overnight, my SIP numbers cannot change. So tomorrow market corrects. Obviously, I think lump sum will take it over in terms of share. And tomorrow, if the market is, and longer term, if the market is not doing that great, that time we will see that the new flows or the fresh flows will come down significantly. And that time you will see that the SIP sales is much higher than the new sales. But long term, I think currently system is 50-50. Specifically, if you talk about whether the flow has come in the month of March or April, I would say that the difference in Jan, Feb, March, if I look at the fresh flows, hardly any difference. I think, of course, there was a difference of around 100 crore. You can say around 10% deviation in the Jan, Feb, March number. But you can't say that I think the March number was 30-40% higher than my January number. So it was hardly 100 crore difference in Jan and March number. So yes, there was a difference, but not much.
Understood, sir. And the second question is predominantly on the SIP market share. That monthly SIP market share, if I see it's been stuck in that zone of 3.5 to 3.7 kind of a number. Just wanted to understand. I mean, this pain is coming from more other platform companies where we are not able to expand market share. It's not pain, but we are not able to expand the market share. Is it largely coming from the other platform companies, or is it more people choosing to take direct? In your view, sir?
So definitely, I think you would see that more and more people in the industry market share of direct is increasing. So when you are comparing the share only on a total SIP registration, if you are saying that we have maintained in a scenario wherein the overall share of direct is increasing, that way you yourself is saying that I think we are gaining the market in a regular plan. So that says that we are not losing the share to other competition platform or other regular plan platforms. On that particular space, we are gaining the market share, but when we are talking about the overall industry, yes, I think the share is maintained.
Understood, sir. Absolutely correct. But any number you have in mind, sir, like this number should be at least 4.5% in medium term as a market share?
So practically, I think we don't target this kind of number, but of course, I think we keep on tracking the growth or the share month on month or quarter on quarter. And I think every month it is at least few basis point higher than the previous one. So I think we are on the that zone that I think we are growing. But specifically, if you say that are we targeting 4%, 5% of the market share that way, I think because direct I will not be able to control how the direct goes, how many platforms will become stronger on the direct side. I think it is anybody's guess to say. But yes, I think always there is a focus that we should be able to increase the market share in the overall industry and specifically on a regular plan. But no number in mind.
Okay, understood, sir. And lastly, on this, due to GST thing, the unorganized MFDs who probably don't pay GST, in your assessment, how big is that number, or how much AUM is managed by them? And if they come on the platform and if we take a bit of market share very similar to what we have today, maybe too early to tell, but just any numbers you have in your mind, how many people are there, how much of AUM is given by these guys, managed by these guys, and if they come to our platform, how much potentially bump up we can see in the AUM in that sense?
So here, definitely one thing is very clear that the competitiveness of platform has increased compared to what it was last year. Now, how this will play out, I think only the time would say. I don't have any exact number on the industry side that what percentage of the AUM these GST, non-GST guys were contributing. But I think AMCs would be the right person or the RTAs would be the right person to give you the number. But I think what I understand, again, I think I would say that it's not the authenticate number, but what I heard in the market, maybe around 15 to 16% of the AUM is contributed by non-GST registered partner. Now, whether this is the entire industries or only MFDs, even I'm not too sure right now. So in terms of number of distributors would be much higher, but the contribution in terms of overall AUM definitely would be much lesser than what it looks like. So of course it's an opportunity for all the platforms that these non-registered distributors may join them. But it is not only non-registered distributor. I think I would say that the entire industry for that particular matter, the platform competitiveness has increased, whether it is non-registered or the registered. So only thing how it plays out, I think let's see, I think after 1 year we'll be able to see that how it works.
Understood, sir. Thank you. Thank you. That's it from my side.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. Sanjay Shah for closing comments.
Thank you. Thank you, everyone. I think we probably tried to address all the queries. However, if you have any question, you can definitely reach out to our IR guy, Parth Parekh, who will be happy to answer all your questions. Thank you very much. Thank you.
Thank you. Thank you.
Thank you. On behalf of Avendus Spark Institutional Equities Private Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.